Okay, let's get into it. Basically, we're going to go over the covered call strategy for long term investors. And this is the ultimate guide. And basically, if you're in a stock for the next 5 to 10 years and you've done your homework and you know what valuations that the stock price should hit, then this is basically going to be the ultimate guide. And it's going to be for intermediate to expert. I'm assuming you guys already know what a covered call is. And if not, you can always find additional content on the webs. But let's get into it. So, overview. We're going to go over why you want to sell covered calls and choosing the right stock, managing the expectations. What kind of gains can you expect? Choosing the right strike price, very important. How to play earnings reports, how to play investor events. Using my favorite strategy in technical analysis, basically linear regression to predict upper bounds. What to do when the stock price moves against your trade. Rolling out of the money, rolling the price, rolling the options out of the money, rolling the options in the money, and infinite rolling for victory. So let's get into it. Why sell covered calls? Basically, it's free money. I mean, I don't know why more people don't do it. But in all seriousness, I mean, it's basically because stock has limited upside potential. And you probably think that the stock has overran too much. That is the easiest time to sell covered calls is after a huge run up and the IV is elevated, so there's a juicy premium to make, So the macro environment is weak, like inflation rates, deflation, governmental policy, war, trade tensions. I mean, if you expect that the macro situation is going to be bad for a while, basically covered calls is the best way to hedge against some of the downside because number one, you don't want to sell your stock and you're going to pay taxes. And so the next best thing is to kind of hedge with possibly selling some covered calls. So to hedge against the downside weakness. And the cool thing about covered calls is that you get paid up front. It acts as income and you get to reduce your tax. So these are all like amazing things that the covered call is going to get you guys. And I mean, you just got to start selling the covered calls because they're so amazing. And yeah, I mean, I say tax reductions. You can set up your covered calls in a way where you don't have to pay as much taxes. Choosing the right stock. You want a stock that is appreciated significantly before selling the covered call. And, obviously, if you just bought the stock, yes, you can sell covered calls. But you're going to have to do, and we'll get into it later, you have to do this thing called the infinite roll. And, but basically, ideally, you're in it for the long term, you're investing, you're willing to hold for 5+ years, and you've decided that, hey, you can't really pick directions. Like every time you buy a call option, the stock price goes the opposite way. Because, unless you have an advantage in knowing that the big guys are going to buy in right after you do, then you probably don't want to be buying call options. So it's very hard to predict the future, and that's why selling covered calls is just guaranteed money because you don't know what will happen in the future. You just risk potentially giving some upside. But I mean, and I will say that you do want to choose a stock that's more volatile, and the reason for this is that since you're already long-term invested, the short-term price movements don't really matter as much because you're thinking that, okay, over 5-10+ years, this stock is going to 5x to 10x from where it is right now. So, you don't care about some small volatility minus 20%, plus 10%, because in your mind, over 5 to 10 years, this stock is going to 5x to 10x. So, and typically the kind of stocks that follow this is like growth stocks and tech stocks, basically. And you've done your homework and you've seen that this stock is growing the revenue by an amazing amount, or it's growing the bottom line by an amazing amount, and it probably will continue. It's going to get more customers to use their product. Then, you definitely want to be investing in that stock. Strong fundamentals without bankruptcy risk. Just check that the company has a lot of cash and that the debt burden is not large enough to put that cash balance into the negative or the red. Choosing the right stock. Managing expectations and misconceptions. So basically, the typical returns of selling covered calls is 0.5 to 1% per month on top of realized gains. This may not sound like much, but it's actually pretty amazing because these are guaranteed gains. And if you get guaranteed gains, then it's like just free money, right? Because nothing can go wrong. It's like not even like if you're at the poker table and you get a bad beat, like no, that can't happen, I mean, maybe the stock price shoots up crazy. That would be like a bad beat, but in most cases, it doesn't do that. So, and basically, this is on top of your unrealized gains. So, as long as you're choosing strikes and you're adjusting your strikes by a lot, then it's just basically pricing in 20, 25%, 35%, 40% upside gains. You're still gonna get that, and then you just choose like a far away enough strike. Misconception number 1: covered calls caps gains. This is not entirely true. You can always roll up and out and add time, and we'll show you that later how to do that. In the example, covered calls gains are too small. Over 30 years, let's just say conservatively, you can compound it 8% annually. $100 becomes $1,000. And then these are like 10x returns. So no gains are really too small. If you just keep selling these covered calls and then you put that money just, buying outright stock, I mean, you're just making compounds over compounds, and it's pretty insane. Choosing the right strike price for core shares. So what has worked for me? Goal is to not get these shares taken away. So we're choosing strikes that are relatively out of the money, and there's no events coming up, no investor events, no earnings reports. So we're just making faded decay because nothing in the market's really happening or the macro is bad. Market cap matters. So basically, if you're a large cap company, basically, I don't know what the large cap is, like 50 billion or higher, becomes very difficult to move these shares up with 20 to 25% upside with 7 days to expire. It becomes very difficult to move these shares up because it's going to take a lot of money, billions of dollars basically, to move the market cap up. And I think actually large cap might be like 100 billion, something super high. But the strikes that I like to choose, it's typically like 20 to 25% upside with 7 days to expiration. So this is like weekly FDs you're selling. And they, it's most likely stock won't go up 20%, 25%. And yet we're getting all that appreciation plus the premium from selling the covered calls. Or 40% upside with 30 days to expiration, or 50% upside with 45 days to expiration. This is assuming that you choose a somewhat volatile stock that's going to have significant premium with 50% upside. And when I say that, it's like choosing the strike. It's like, for example, stock price is at 100. I'm choosing the 150 strike with 45 days to expiration. And so that's how I like to do it. So that's just like a rough general guide. Choosing your strikes. Choosing the right strike price for aggressive covered calls. Create a tax advantage account or a Roth IRA account. And basically, keep one contract to sell aggressive covered calls separate from the core holdings. So Basically, we're putting at least one contract. Let's say you have 10 contracts, enough, you have 1,000 shares of something. We're using at least 100 shares or one contract in a tax advantaged account. And what we're doing is we're selling at the money covered calls and cash secured puts, basically the wheel. And we're returning 3 to 5% per week for most growth stocks as long as the stock remains flat, depending on how volatile the stock is. So you're hoping that the stock's not really moving much, and yet this one part of your portfolio, the tax advantage part, keeps selling these at the money contracts, basically getting you 3 to 5% per week. That's just amazing. And it's going to start to run up eventually, but it's just something to do. And in the meantime, when the macro is bad, something to do. How to play earnings reports. If implied volatility remains high for any dates after the earnings reports, you want to sell covered calls past that earnings report date to maximize premium. So basically, if earnings report is on 7:30, we're choosing 8/6 expiration as a strike, and typically like 45 days out, like we've seen, 45 days out, and 50% upside, or maybe a little less depending on the sentiment. I can't tell the sentiment of whatever stock you want to do, but choosing good amount upside and good amount premium. And then secret is, and why are we doing it past the earnings report date? Because the implied volatility is elevated up until the earnings report date. So you want to choose something after the earnings report date, and that's basically just 1 week after, 2 weeks after. And the secret, and one way to do it, is to exit before the earnings report, and that way you take no risk if the stock pops, if they have good earnings, if it's not a buy the rumor, sell the news event. Because sometimes the stock will run up prior to earnings report, then it's like, oh, we better it might sell off, more likely to sell off if there's a run up before the earnings report. But if the expectation is really bad for the event, we can excel options that will hedge more for the downside, just sell high delta covered calls. And just recall some of the Greeks. Basically, delta is the exposure to underlying stock movement. If an option price has a delta of 0.33, that means option premium will move 33 cents for every dollar of stock price movement. So choosing a higher delta will give you higher hedging for the downside. Another way to think of that is that the option is pricing in that it will be in the money 33% of the time. And expecting a bad earnings report, we want to use high delta to hedge the downside, because the options premium will move like 0.5 for every dollar of stock price movement. So we're just going to make that theta decay so quick, 0.5, and if it goes down after the earnings reports. So here's an example of how to play it. What I've been doing is like Tesla is an example. I'm heavily invested in Tesla. Basically, you just want to buy the rumor, sell the news. And the psychology is, if you're hyped up about the event, expectations may be too high, and the stock goes up before the event, and then maybe there's a sell-off, Or if good news surprise and there is no leaks, the stock will pop. And examples of that are autonomy day. Oh, no, sorry. That was not examples of that. But if good news surprises and there were no leaks, the stock will pop. Like maybe they posted better than expected earnings report, and that's when the stock goes up. So these are examples of buy the rumor, sell the news, as though. Basically, it all sold off after these events. Autonomy Day, April 22nd, 2019. Cybertruck reveal, November 21, 2019. Battery Day, September 22nd, 2020. After all these events, stock price sold off. So, but there was a run-up, before the events, small run-ups, and, that tends to happen. Stock price tends to revert to the mean. This is also known as mean reversion. At the outer edges of the mean, we like to sell our covered calls or cash secured puts, because most likely the stock prices will revert to the mean. What I mean by the mean is just the arithmetic average. It's basically a line, a trend line. You can draw it any way you like, but the point is that in most cases, the stock is trading like a sine wave, and it's going to return to that middle line, kind of the average. Without getting into mathematical formulas, Black-Scholes explains how theta decay on top of mechanical movement hedging leads to consistent gains. So basically, it's just saying that Black-Scholes has based the options pricing on mechanical movement, and yet it doesn't take into account like a mean reversion, the tendency to move back to the mean. It's pricing upside the same percentage as the downside, and so in this, in my opinion, is basically like a bell curve, and that bell curve moves with the stock price, right? Here's the bell curve, and stock price moves here, and bell curve moves here, and the probability over here has remained the same 20% out as it was when the stock price was over here. So that, in my opinion, is not it should not really be correct, because like if you're a huge market cap company, you know, as the stock price goes up, you know, your upside probability keeps going down. So I mean, it's just kind of an anomaly like that. Let's go into the linear regression, and basically we're seeing that here is a trend line, and here's a stock. You know, it's reverting back to the mean typically, and you know, this line changes with the window size that you choose, but the principles are the same because we trade with a margin of error here. If we look down here, we're selling the 300 strike cash secured put, and you know, back here, if we look at it, it's like, okay, there's a little bit of a dip, and yet the line is here. So the tendency for the stock price is to basically bounce back to the mean most cases. And so basically we want to be selling margin of safety down here, sell our puts down here, and you know, I can make this premium in a tax advantage account. And on the flip side, it's like, okay, if the stock price has gone way above the mean, now we begin to sell our covered calls here, and we sell this covered call here, like maybe it's 680, and then but the stock price destroyed our strike price of 680, so yet we roll it. We add some time, we add a week, and we can keep rolling it. We keep rolling these strikes until we get out of it. You can get out of it out here over like something 800, and then you collect your premium on top of your unrealized gains. So basically, you just hedge for the downside. You got additional cash. I think I got something like, you know, 20K just by rolling it up here, and the stock price crashed, and I got all that premium because I kept rolling it in the money, adding $500 per week. Now it's extra cash on top of my realized gains because the unrealized gains came back down to here. And so yeah, it's just a really strong strategy for one portion of your core holdings to keep doing this as a way to hedge and, you know, take money out of your account if you feel like it's gone too high without selling your shares. If that makes sense. Like basically we're just getting money out of the contracts based on our shares, based on our core shares. We never sold any shares, and yet we're kind of reducing our cost basis like that. And so yeah, you know, if it keeps dipping like this, you can sell cash secured puts with a margin of error. Dips again, cash secured puts, margin of error, like that. So that is kind of the interesting strategy about selling options in the general strategy. When stock moves against trade, just do not panic. I mean, there are ways to get out of it. Best case is wait it out near expiration to see if it'll drop back below covered call strike. Get close to the expiration date. If a stock moons, there's a low chance it will drop below covered call strike. Choose a nice green day to roll the contract. So you want to choose a green day because the premiums mechanically move, and they're most likely going to be higher for your covered call strike. And you know, but obviously you want to roll on a green day because basically the premiums are higher. Like even if you roll on a red day, and the difference between one strike to the next strike is the same thing, But the difference between that is you're not getting as much premium as if it were to be multiple red days, if that makes sense. Like you basically want to roll when there's the highest premium, and that's going to be on a green day, and a strong green days, basically. Roll means buy to close your current contract, and then sell to open a new covered call. And the interesting thing about this process is that we will buy to close at a loss and sell to open at a small profit / net zero, and or raise one strike price increment. So here's an example of how to roll a contract. This is just not out of the money, but it just happens to be here. This is the best case when you roll and collect a profit. The stock price has remained flat or down, and you collect sweet premium. So stock price is just doing this, and yet when we roll, we're gonna roll from one strike to the next strike and collect more money and add more time to our contract. Rolling just means getting another contract and adding time, basically. So let's look at this. We have a 7/30/21 expiration right here. Today is 7/6. I actually took the snapshot and made this recording before going on a trip. It's actually a little dated, but the example still remains. Like, okay, we have almost 20 something days to expiration, and the estimated premium to receive is $282. We sell this contract, we're going to make $282 right off the bat. And so, compared to $850, like, it doesn't seem a lot, but just imagine that your cost basis was way back in the 40s, 50s. Yeah, this premium is a lot. So because we're long-term investors, like, this is the power that compound interest will bring to you once your shares have appreciated. It's kind of the cherry on top, and a way to reduce your cost basis to zero, or buy more shares and double down if you have high conviction in the stock. So now let's look at the next week after this. 8/6 and 8/6/21. We're adding a week here. Look at the increased premium now, and it's the same strike. 850 strike, 850 strike. We're adding almost $130. This is wrong. It should be $130. Adding time to the contract at the same strike price. But at the market close, Tesla's at 659. So it's implying, like, I don't know, 20 something percent upside to 850. So that's rolling out of the money because we're adding time. Now we get to add premium. And look at that massive premium just for adding time to this contract. And it's just amazing that you can keep doing this, rolling and just getting more covered calls, collecting that sweet premium, theta decay. Rolling out of the money, look at the theta decay. I was just randomly keeping track of one contract here, and I don't like buying it because, like, for this whole time we needed the stock to pop crazy, and yet it didn't do that. So this is the 730 650 premium. It's basically 650 covered call. It's basically at the money because, as we saw, 6.9 Tesla was at 650 something. But yeah, so 6.1 premium's like $3,000, and it bled out for like 23 days. Look at that, almost down half the cost basis. So very scary to be on the other side of theta decay. I like to sell the options where theta gain. You know what I'm saying? And so, but I mean, obviously it did work out for Tesla for this contract, but I just don't like that risk of theta decay. Had it go on another month, and yeah, you would have been bleeding out here. So stock price at close, so it's relatively flat here. I mean, and yet the volatility on that options premium is crazy. I mean, if you put your whole portfolio in that, it's like minus 50% swings are just normal for you. And selling covered calls is a way to reduce your volatility at the end of the day. But I mean, just to show you, like, theta decay is so nasty because this stock price barely did nothing, and yet for these 23 days You know, it just got hammered basically. And there was a little pop here from 620 to maybe 680, and that's what kind of got it out of the red there. But oh man, I don't want to, stress so much uh, buying options and be down like 30, 40, 50% and be worrying about it. It's like it's just this is not my style. Um, okay, so rolling in the money. This is a bittersweet moment where your underlying shares have rocketed. Basically, your core holdings have gone way up, but now your covered call is in the hole. Don't worry, we're going to get you out of it. Basically, there's two different strategies here: is roll at the same strike, collect faded decay, like we saw. Just add time to it. I mean, because this money you set aside is for income. It's only one portion of your core holdings. So roll up or roll up and out and attempt to get out of the position and hedge for the downside. So basically, you can roll it up and out, and that'll get you out, like basically the infinite roll that we saw. Let's just see how to roll it at the same strike. Or no, we're talking about rolling it up and out. Here's another slide showing right here. So basically, we're looking at the 7:30 expiration. 622.50 gives us. We're selling at the money contracts here. Gets us $5,000. My gosh, that is like a lot of money just to sell this option. And then we can roll it. Let's just say that we got overran. It tests us at 800. We can roll it to 630 for the same premium almost. 59.95, 59.60. Okay, maybe we pay like $35, but now we're just raising the strike. In 1 week, we raised the strike $7.50. That means $750 in our pocket. That's just amazing. Like we're just adding money basically to our contract to get out of it. So infinite roll here. I mean, we're basically just keep rolling the strikes up and up, up and up. Use the infinite roll for overran strikes. Use the cash secure puts on extreme weakness and elevated IVs. So if we look at this and we look at the chart and it's going up and down, it's kind of bouncing, and you see this drop right here, the implied volatility is going to go up. And so all the puts, when you sell puts, you make more money because the implied volatility is up. And then when it stabilizes here, we make it money on the applied volatility because it goes down. And then when it goes up, that's mechanical movement away from our strike price, and we just close out our contract because we made our money there. And then as we went over, the infinite roll is just an underutilized tactic that more people need to do, because basically you can hedge for the downside. You can make $400 or $500 per week. Do whatever you want. Get out of your covered calls, and at this event, it's like you can generate losses all the way up here, and then boom, it crashes. Yeah, you made a good amount of money. I hope you guys YouTube enjoyed that. That was kind of a quick overview of the covered call strategy for long-term investors. And I think if that was helpful, just please like and subscribe. That really helps out the channel. And thank you guys.